When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what matters right now for retirees, pre-retirees, and investors, and where the opportunities are emerging. We'll also answer listener questions, and finally, are you on track for retirement? My name's Jeff Shade. As always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management, right here in Tucson. Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic. Thank you so much. And of course, we've got a great show lined up for our fine listeners right here in the greater Tucson area. So let's get right to it. Jeff, when people hear about war overseas, they think it's far away, but what they're really feeling is higher gasoline prices, higher groceries, and more pressure on their retirement. So today, let's connect the dots, because this isn't just about geopolitics. It's about people's wallets. And I do want to talk about some opportunities that are presenting themselves as a result of this. So why should retirees really be paying attention to what's going on in the world and domestically right now?
Well, the world is a smaller place than it used to be. It used to be that things that happen here stayed here and things that happen over there stayed there, but it doesn't. Everything is so intertwined and interconnected, just geopolitically, economically. What happens around the world affects here, whether it be tariffs on goods, whether it be trade, whether it be energy, being able to get through the Strait of Hormuz, whether it be the price of gold and other governments hoarding it, like China and other central banks have been for the last several years, driving the price up. There are things that create opportunity if we watch and see them, but there are also things that create some angst and some frustration and some, anxiety due to the fact that things can get a little bit out of whack and inflation can happen, things get harder and harder to deal with, and maybe more unknown. And that's why we come back to the purpose of the show, and that is try to encourage people to get a plan and to get into that situation where you have peace of mind, knowing that whatever happens in the world, whatever happens, that your plan is safe, that you've got your foundation and your financial house is in order. The foundation is built where you don't lose money, regardless of exchange rates, regardless of energy prices, regardless of things like that. Well, to a certain degree, we have to build in some flexibility in the fact that we know inflation is going to happen from time to time, and sometimes it's going to be a little out of range, a little bit more than we expected. That's why we like to build at least a paycheck plan to where you're getting the paychecks enough to make sure that all the regular bills are covered. And then that some sort of security, or if not a guaranteed income stream, a predictable income stream for those things that are more discretionary. And if you have that, and your money is going to last long because it's not all at risk and could be gone in the next big market crash or the next big world war or something, then you can at least sleep through these things, wake up, watch the news with more of a neutral position rather than a reactive one where you think, oh my gosh, I've got to sell by Thursday or I'm going to lose everything. Or, gee, should I sell? Or, gee, do I put all my money in gold? Well, some people who thought about that a couple months ago are wishing they hadn't. It's down 20 or 30%. People thought of that 6 years ago are happy and probably selling into the rally and making some money, locking in some profits. But again, nobody really knows the future. Nobody really can time the market. We can, as far as from year to year, long term, you can kind of time the market from a day-to-day basis just on what's being said out of the White House, just based on what's in the news, because world things do matter. We notice every time the war in Iran is supposed to be over, and we know it's probably going to be longer even if it is supposed to be over. All of a sudden, oil goes down and tech starts going up, and we all of a sudden assume that the bond market is going to get better because they're going to lower interest rates. Well, that's not necessarily true. In fact, we haven't seen that happen. All we've seen is basically market makers allow the news to start a sell-off or start a buy, start a rally, and Main Street's trying to react a day late. And unfortunately, a day late means $1 short because you're getting in late, getting out late, and you're just late. So investing is hard. It's actually been probably tougher even for us the last month since the war broke out, and trying to watch and make sense out of the news and what's happened geopolitically and what's happened around the world does create opportunities if we know where to find them and we know where the money's flowing, and we kind of watch that. We're finding out that energy seems to be kind of the most consistent play lately. obviously, and it doesn't take a rocket scientist to figure that out. I would think that the defense stocks would be doing better than they are, but they're not sure why. I think maybe they will soon, but they've had a little bit of stability, but they haven't sold off like some tech stocks have, but they haven't gone to the moon like oil has. I think oil is kind of the first thing that'll happen, and it may be topping out. I don't know if it's kind of made its run and will settle in until we figure out what's going on in Iran. Not everybody buys their oil from Iran. We don't buy all of it from there. We buy a very small portion of it, even though Iran, I think, supplies, or at least the Strait of Hormuz supplies 20% of the world oil. I think only a small percentage of it actually comes to us. And so we're not as dependent. However, because local suppliers and drillers and producers of oil have a bigger market and can raise prices by selling it and exporting it, it does raise the price here, even if we could drill it and process it quicker and cheaper. So again, it's world economics that make the difference. If we were self-sufficient in oil and all the oil companies only produced oil, refined oil, and sold oil here, we could probably keep it pretty much in check because we have been and probably are very close to being oil independent. Problem is all these companies also have, footprint is worldwide, not just local. And we have to realize that all these world things are going to matter, and they matter locally, and they matter to your money.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about geopolitical events and the opportunities that they may present. And of course, we'll talk about that in just a moment. Let's talk about interest rates right now, Jeff, because there's a lot of confusion right now. Are rates going up? Are they going down? Or are they staying put?
Well, it seems like they're staying put. There is some inflationary pressures, which typically makes interest rates go up, or the Fed kind of have a bias towards being a little bit hawkish, as they say, a little bit wary about lowering interest rates. However, just due to the fact that prices are going up and people are having a harder and harder time buying things, it may be economically smart, even though it doesn't help inflation numbers typically. It may be smart to make credit a little cheaper so that people can continue to buy houses and cars and things that make the world go round, because those things do also employ people. If everybody just stops buying things because they can't afford credit, then everybody who has a job doesn't have a job anymore, or doesn't have a reason to go to work, or these companies can't, for whatever reason, just keep on plugging away without revenues matching their expenses. So we have to keep that in mind too. I've said this before, is recessions happen, and if we're not in one, we're on the verge of one. I mean, all the indicators have shown that we're due for one, and how it shakes out kind of remains to be seen. And it may be mild and it may be severe. I don't know. If hedge funds and market makers decide to just have a mass sell-off, we're in trouble, because they basically control the market. Even though Main Street now owns 60% or more own stocks and are investing on a regular basis, they're the dumb money. Sometimes they get knee-jerk reactions, and the Wall Street machine can manipulate them. And all of us do if we pay attention and don't look at what's really happened. And so we've seen Warren Buffett, Ray Dalio, and some other big hedge funds and money managers move money to bonds and cash, and they're not jumping back in the market every time we have these little rallies. These are done by basically the small money, not the big money, not the Wall Street box stores. They're just kind of sitting back. I think they're selling into the rallies and laughing all the way to their own bank. And we're just waiting for these bounces because we've been taught to buy on the dips, buy on the dips. Well, buy on the dips is also when those market makers who believe the market's going down would love to sell you their stock at a higher prices. So buy on the dips, make the price go up so they can get out with a higher price. And that seems to be what's happening more lately than it has in the last couple of years. We had some really good years making money in our aggressive growth funds. This year, we started out good, and it's been a little bit tougher now. And I think that's the case for everybody. But if you look at the indexes, they're pretty much flat for the last 6 months. And they're on average down of about 5% year to date as we record this. So the markets, even on the index basis, are down. The big stocks, the Mag 7, are down even more. The high tech stocks are down even more. Some of the semiconductors are kind of holding out okay and had a little run at the beginning of the year. But if you look, just the weakness in the market, except for a rally a week or so ago that looked like it was all over because there was a rumor that the war was done and oil went down and tech went up. And there's a few bright spots in the tech market that are still gaining speed momentum due to the AI push or the AI frenzy, I guess. But there's a lot of those AI stocks that we're finding out were based on more hype than value and more hype than reality. And the other thing is that the market share is the market share, and it has to be shared. It's not every company assumes they're going to own because they have a niche in the market. They're going to own every bit of that business. And that's just not the case. We've even seen companies like Intel that we thought were dead coming back into the chip market for PCs and stuff, especially in the personal basis, but probably starting to supply manufacturing capacity to companies like NVIDIA and stuff like Taiwan Semiconductor and some of these other big companies that are basically partnering up with some of the huge chip companies. NVIDIA isn't doing all of it alone. They're contracting and they're sharing a lot of that business with other big tech providers. So there are a few bright spots. We are still seeing some momentum growing, but we're also seeing that market share being spread around a little bit. And I think there's going to become a day of reckoning when we realize that those overpriced stocks are truly overpriced. And if they settle back into a more realistic rate, that's just realistic. It's unfortunate people think that just because the stock market went up, that's real money. It isn't until you sell it. And unless you sell it and turn it into dollars or put it into something that doesn't depreciate, those stocks can go down even faster than they went up. In fact, typically they do, about twice as fast down, if not more, than they go up. If you look at a chart, you'll see that the downswings are pretty severe and the upswings take a while. So you got to gain momentum, look at buying the market back. And right now, I don't see a lot of the market being propped up by a lot of the institutions, the people that typically prop it up. So, let's see what happens. I think we've got a long time before we'll really know how the year shapes up. I don't think anybody who's calling for a up year, a down year knows whether or not they're right. There's so many things. Again, back to the geopolitical thing, we're a worldwide market, even if it is based in New York. And even if you do live in the US, everything you buy, even in local based companies, are still affected by everything happening in the world. So again, goes back to the same, reiterate again, if you have a plan and you have enough safe money that's principal protected, you don't have to worry about what might happen to the market. If you risk only the money you can afford to lose or wait on, or the money that you don't need for your monthly bills, then you're probably in a better position than those people that are really worried. And I've met a few just recently that have multi-million-dollar portfolios, all of which are in securities, that could go down to a fraction of that if they just ride the wave out. And they've been very tight with their budgets because they know that it could be gone. So they want to make it last, and they want to make sure they live within that 3 or 4% rule, so that if the market crashes, they're not going to be out of money. Well, you could put half your money in stuff that guarantees the same income you were taking out on that 3 or 4% rule, and risk the whole other half and not worry about running out of money if you just utilize some of the products and services that are out there that aren't Wall Street products, and Wall Street hates them. I mean, insurance products, insurance and annuities are ways to secure more of that income. That's what they were built for. They're built for tax privileged income. Benefits from savings taxes sometimes outweigh the benefits of upside, especially when you leave the downside out there. If you take the downside away and you have tax savings and guaranteed income and upside when the markets are good, you will find, because the math proves it, history proves it, that your money will last longer and you can have more peace of mind.
Jeff, I want to talk about the opportunities here in just a moment, but before we do that, I want to remind listeners that if you're listening right now, this is one of those moments where the environment has changed and your plan probably needs to change with it. At Premier Retirement, we're helping people adjust to this exact environment right now. We're going to show you how inflation impacts your plan, whether you're taking too much risk, how to generate reliable income, and how to take advantage of the opportunities that are presenting themselves right now because of what's happening in this country and around the world. Entirely complimentary. There is no obligation for this conversation with Jeff. To get yours, call 520-780-9059 right now and schedule your complimentary Premier Retirement Roadmap Review. Again, it's 520-780-9059. Leave your name, telephone number. Shelley will call you back and set up that appointment. Again, no cost, no obligation, and it's just a casual conversation. 520-780-9059. Don't let a changing world break your retirement plan. Adjust to it. Okay, Jeff, let's talk about some opportunities that are presenting themselves right now. You talked about artificial intelligence. Some people are comparing this to the Industrial Revolution. They're saying that this is the new Industrial Revolution. What do you think about that with AI and the opportunities that it may present?
Well, I think it's similar to the Industrial Revolution. We had the dot-com bubble that blew up, and the dot-coms, the internet is still an integral part of the world economically. Think of all the stuff we can do so quickly now, just at the tip of our fingers. It's the whole reason we can even have AI. And it's taken 30 years to develop it to the point where we've actually got an internet that is so networked to everybody's information. No matter how you feel about that or not, all your information's up there, all your experiences are in there, all the company information is in there. And because of that, you can have AI that can digest and assimilate all that information and make sense out of it, whether we can or we can't. And when that happens, we can do more things, be more efficient, make more money, live on higher income, have more wonderful life experiences if we do it right. It is a double-edged sword, just like any bull market is, and that is that there's always going to be a few winners and losers. You have to be careful. I think we are in an industrial revolution, or another phase of it. This AI phase is here to stay. I think that what remains to be seen is just how the efficiencies in AI will produce so much maybe free time or ability for us to do more things, that it will open up new industries, maybe the leisure industry, which you can't do leisure on AI. I mean, there's no such, well, I don't know, unless you just do a virtual sit in your bed with one of those funny pair of glasses, the metaverse glasses on, and pretend you're in Bora Bora. But I think going there makes more sense. So maybe the travel and the hospitality industry booms. Maybe the recreation industry booms because we can have time to play more golf and racquetball or pickleball or whatever. AI does not have to blow up everybody's job. I mean, it might blow up a few tech jobs. Some of the programming, for example, is actually done by itself. I mean, a computer can program itself and write apps and things like that have never been able to be done before. So I think there's going to be kind of a shakeout of those people that can stay in AI and continue to develop it. But there's going to be a lot more job creation outside of that. So I do think it's a big change. I think we're going to see a shift in the next 5 or 10 years that will make the future world look a lot different than the world today. I don't think we're just going to walk around being zombies, living with a robot next to us, doing everything for us. I hope we all continue to want to do stuff for us because I think humanity wants to feel useful and needed. And I certainly would, whether I buy a robot or not. And I may, just because it's an AI thing and it might mow my yard cheaper than the guy that shows up every weekend. I don't know. But there's all kinds of things that would be easier and benefit, more pleasurable with AI. And at the same time, I think because of the unknown, we're a little more fearful probably than we need to be about it. Americans and humans have been so resilient and figured out ways to make everything work so far, even though there's a little shakeout process that happens like we did during the dot-com bubble and then the dot-com bomb. And we're going to have probably a few of those things in the AI business as well. Unfortunately, America's a free place, but it's not necessarily a fair place. Sometimes we get lucky and get in the right situation, make the right investments, make good decisions. Sometimes we make inadvertently, whether it's our fault or not, bad decisions, and we get to live with those consequences. Again, it depends what you do with it. Are there opportunities? Yeah, there are definitely opportunities. Are there risks? Yeah, there are risks. Can we deal with them? I'm sure we will.
Jeff, I know that you get up during the week very early in the morning. I mean, like 5:30, because you're taking a look at the market and you're looking for opportunities that exist on that day so that you can take advantage of them before they go away. We've talked before about investing in defense stocks and defense investments. Has that ship sailed just yet?
Yeah, I mean, I look at the defense stocks kind of in the ETF form because they typically hold the defense sector all at once. And you could pick a couple of stocks out that might have done better than others. But honestly, most of them are kind of choppy. If you look at just before January, in fact, most of the defense stocks surged, but long before the war. I mean, was it because they knew something was going to be happening? Maybe, I don't know. But, you know, if you have roughly a 10% or 15% growth in defense stocks in January, and right now, if you look at year to date, the defense sector is maybe up 10%, but most of that was January. If you look at just the last 3 months, after even the first week of January, which is where we're at, first, second week of January, we're looking at break even. We're looking at 4% a week ago and 0% today. So are defense stocks lagging? Yeah, and I don't know. So I think if we're going to invest in defense, maybe it's a time to accumulate some of those defense stocks because I think either they had a pre-run because insiders knew something. I wouldn't doubt if it was the case. But I think more than that, I think it's lagging because nobody knows how long the war will last. Nobody knows how many things how many bombs we're going to use up and shoot, how many things we're going to order, if we're going to order new stuff, if it's going to be from Lockheed or from Raytheon or some other company. I mean, who's going to get all the benefit of that growth? I think still remains to be seen. I don't think the government typically just hands all their money to one. They typically spread it around, but there are always winners and losers in the defense game at any given time. So I think we have to be a little bit more cautious. You know, if we look at our local Raytheon defense contractor, I mean, up 5 or 6% year to date, and it's actually down since the war. It's gone down almost 10% since the war started. That doesn't make any sense to me. So yeah, I don't know. It's a crapshoot. If you want the market to work on logic, we have to go back to the days of fundamentals when price earnings ratios meant something, when growth rates meant something, when the news of a government contract meant something. But now those things don't really exist. It just depends who's buying what and why they're buying it. And I think it's more of a manipulation market maker process than it is fundamentals. We just have to kind of follow the money and follow the smart money. And if we follow the smart money and see what they're doing, then we have a better chance, I think, to be on the right ride, go in the right direction at the right time. If we don't, we can make fundamental decisions and wonder why they don't make sense for years or why they don't make sense for months. But, you know, to answer your question about defense stocks, I don't know that we should be jumping in until we see the money going in. I like to see some confirmation that institutional money big money is starting to buy those stocks, and there's a reason behind it before I would just jump in with both feet. So right now I don't think we're holding any pure defense stocks. We're kind of on the sidelines right now.
Jeff, want to talk about oil? It's on everyone's mind. Certainly we know that when we go to the gas pump. Is oil or stocks related to oil or investments related to oil, are they still a good investment? Or if we bought them today, would we be buying high and then selling low later on?
Well, we're definitely buying higher than normal. I mean, shoot, it's not very often that the United States Oil Fund, I don't remember when it hit $140 last, and that's U.S. oil. In fact, I think in 10 years, it's at an all-time high. I think the most it ever was at before was maybe 130 or so, maybe even 120. So we're looking at huge money for oil right now. I mean, you never get hurt taking a profit. But with that said, if you look at the last month, oil's up 17 or 18%. The last week, it's up 10%. In the last 3 months, it's up 100%. So, is it time to get out? Well, I don't know. If you were in it 3 months ago, it's a great time to take profits on probably half your money, and then you're playing with the house money from here on out. The thing is, though, you can always go back to the trend is your friend. We still have positions in oil. We have increased our positions in oil over the last week or so because the momentum is still up. But we can also get out tomorrow if the momentum stops or if it looks like big money selling. Now, it could also fall 5 or 10%, but if we're up 30 or 40, we have house money to play with. We've already got some gains that are in there. We do rebalance our portfolios on a regular basis, so we're generally taking profits a little bit off the table as we go. But oil in general is up, and everything that has to do with oil stocks, Exxon, Valero, and those stocks their trend is definitely up. There are some energy stocks that are a little bit disappointing. I'm not sure. Maybe it's because they're getting a lot of their oil from the Middle East, and they've got some hiccups with their transportation and supply issues and things like that. So, the market's basically telling us what those are. But we've seen a lot of different oil and gas companies that now, based on their earnings and projected earnings, have price earnings of way under 10, which is a pretty healthy earnings rate, where you only pay $7 or $8 for a share for $1 worth of earnings on an oil stock right now. That seems like a pretty good price. However, if the war ends and oil falls back below $100, people are going to lose 30 or 40% on most of their oil stocks, I think, over a pretty short period of time. So if you're a trader, you can take advantage of these times. If you're a long-term investor, I think getting in right now, if you plan to hold it for a long term, is probably silly. But if you're watching the market on a day-to-day basis, maybe there's still some upside. I don't know. But I'm not here to make recommendations, and please listen to the disclaimers. Those who are listening, make sure you listen to the disclaimers. Investments are risky, and they're not for the faint of heart. And make sure that you know that I'm not making any recommendation for you. I don't know your situation. Even if you are a client, if you're in oil, it's because you've already talked to us about wanting to be there in those type of stocks. But again, we don't make recommendations on here. We just talk about trends, talk about generalities, and talk about why we do some of the things that we do, so that you can understand maybe why you ought to be doing things differently, or why you're happy you're doing things the way you are. Maybe we can confirm that you're on the right track. So again, we're here to help and just give general information here. I just want to reiterate that.
Right, Jeff. And of course, as you said, we're not making recommendations. This is only for educational purposes. You are the one that needs to make the decision about what's right for you. Good conversation, Jeff. Want to talk to our listeners here. This is not a normal market cycle. It's a geopolitical driven economy. And if your plan hasn't adjusted, you're taking risk that you may not even realize. At Premier Retirement, we're here to help people adjust to this exact environment right now. And if you'd like to talk to Jeff on an individual basis, one-on-one, a casual conversation, call 520-780-9059 to talk about your individual situation and what is right for you. Again, there's no cost and there is no obligation, and it is a casual conversation. There's no sales pitch here. It is just you and Jeff talking about your plan and where to go with your investments so that you can have a confident retirement. Once again, 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelley will return the call and set you up with that appointment with Jeff. 520-780-9059 or online at primret.com. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk. If you're planning to retire soon or already in retirement, you more than likely have some questions, like when should I take Social Security? How can I avoid running out of money? Or how am I going to deal with taxes in retirement? Premier Retirement and Wealth Management can help answer these questions. They've been designing retirement plans for people like you for more than 20 years. They recognize that you're unique, so your plan is tailored to your individual needs. They'll work with you to determine what it costs to be you in retirement. Then design a cash flow plan, a tax plan, how to pay for health and long-term care plan, estate plan, and how to deal with the uncertainties of life. If you'd like to begin a conversation to answer your questions, call for your no-cost, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or request it online at premret.com. That's PREMRET.com. Investment advisor services offered through Premier Wealth Advisors, LLC, an Arizona State registered investment advisor.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
Thank you so much for making this part of your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, our telephone number 520-780-9059. Also, a reminder, we're on the air for you 4 times a week here on the radio. Saturdays at 7 a.m., 9 a.m., also 1 p.m., and Sundays at 11 a.m. And as always, if you've missed any part of our program, we're available as a podcast 24 hours a day, 7 days a week, 365 days a year. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, time for listener questions. Bill's listening to us in Sabino Canyon, and Bill says, I'm 55 and married. I make $225,000 a year right now. I'd like to retire at 62, so in about 7 years. I currently have about $1.8 million all in mutual funds and $200,000 in CDs. How should I allocate the $1.8 million between stocks, bonds, and mutual funds and alternatives to balance growth and drawdown risk over a retirement that could last 25 to 30 years?
Well, you're at a good age to start thinking about this, and you've heard me talk about different strategies as far as alternatives. Now, I like stocks. I don't like bonds right now. They haven't really done anything for 2 or 3 years. Mutual funds typically have high fees. I'd rather use ETFs and basically rotate in and out of different sectors when the time is right. For example, consumer discretionary sucks right now. If you had a mutual fund that had a lot of that stuff in it, it's dragging the mutual fund down, yet ETFs with energy are doing great. Even financials are holding out pretty decent right now. So you've got different sectors that I would, honestly, I prefer having someone that looks at the market every day manage. That's why we do what we do. But mutual funds, I think, are very inefficient. You probably ought to just get rid of that word. I think ETFs are better. There are, however, I will say that there are some mutual funds. There's a couple of families of funds that have some extraordinarily good managers that are in specific sectors, like maybe gold or something like that, that a mutual fund might actually outperform an ETF because an ETF might be, an exchange traded fund might be a little bit too diversified and too broad based. You might as well just buy gold itself instead of a gold ETF, for example, or a gold miner ETF might be better than trying to pick and choose what miners are going to do well. Mutual funds, the problem with mutual funds is you can't, they're typically diversified. They typically have management fees on top of 12B1 fees and other things, and probably don't make as much on them as you would if you just manage the actual stocks and bonds. That's my take on it. That's not always the case. But if I get audited, I'm charging you a fee. The auditors always question why I would sell you a mutual fund instead of an ETF that has almost no fee, because otherwise you're doubling and tripling up. So again, if the mutual funds had a purpose, if you wanted something that was just market-based, you didn't have to manage, the QQQ is more of a tech NASDAQ type of flavor. You've got DIA diamonds, they call it. That's the Dow 30 stocks. Basically, it mirrors those. And then you've got the SPY, SP 500. I don't particularly like the ETFs on the Vanguard or Fidelity, which most people that have 401ks and IRAs there do. They're probably a little bit more fee heavy laden and even hidden fees than you would think. But again, to get back to your 1.8 million, you've got 5, 6, 7 years before you kind of really have to button it down. But if you had a growth on, let's say you put $1 million into some strategies that guaranteed you income. You're making $225 a year now. When you're 62, I'm guessing at that rate, you probably make $2,500 or $3,000 a month in Social Security, maybe $30,000, $40,000 a year in Social Security. Your wife will probably do the similar. So there's maybe $50,000 or $60,000 a year. If you want to live on the same lifestyle, you're probably living on about $150 after taxes and withholdings on the $225 now. So we need to make up another $100,000. If you put $1 million in an index annuity or between index annuities and LERPs, between the next 7 years, you could have predictable or even guaranteed lifetime income of around that extra $100,000 and still have $800,000 right now that you could manage in stocks. And if the stock market stunk and you didn't make any money, you still have $800,000. If it stunk and it went down to $400,000 in the next 5 or 6 years, you'd still have $1 million that was paying you out on an annuity as if it were worth $2 million, and you wouldn't miss a beat. I would start locking in that future guaranteed income. I'm guessing that if you have that much in savings, you probably have a big 401k and don't have a pension. You've also got a salary that typically doesn't look like one that typically carries a pension along with it. So I'm guessing you don't have a pension, so make one. If you have guaranteed income from Social Security and a pension making $150,000 a year, and you have another 800, which probably we're going to grow to $1.5 million in the next 7 years, maybe even more, or it could be less, but you don't have to rely on that, then you're in a much better position. And again, I would go into bonds when bonds are going up and interest rates are falling, but I would be in stocks when interest rates are falling and the market looks a little stronger and the prices are a little bit better. But again, whether you manage it yourself, you might just want to do an index fund and bonds and close your eyes and see what happens, or you could have somebody manage it and watch the market for you so you don't have to worry about it.
Bill, thanks for listening to us in Sabino Canyon. And again, if you'd like to continue this conversation with Jeff, call 520-780-9059. You can make that call right now if you want. Shelley will call you back and set up an appointment for you to talk to Jeff. Just a casual conversation. Once again, it's 520-780-9059. All right, Jeff, Sam's hearing us in Rita Ranch. Sam says, I've just retired at 67. I have longevity in my family and hope to live another 25 years. So he's looking to live till 92, 93. How do I balance riskier growth investments versus non-risky inflation protection, real estate tips, REITs with a longer retirement horizon?
Well, I think you need to look at, first of all, making sure that your income is secure, whether it be from Social Security, pension, or putting some of that money, like I mentioned in the last question, into some sort of an alternative that gives you income, either predictable income, tax-free predictable income. I don't know if your assets are in IRAs and 401ks that have not been taxed yet, or if they are in already post-tax. Real estate, sometimes, if you want to be a landlord, can give you some inflation protection because you can keep raising rents. Problem with it is the older your house goes, the more costly it is to maintain. And with inflation, the more costly those repairs and management is to pay for. So the increase in rent typically just keeps you at a break-even level anyway, has been my experience. Tips, they sort of work, but if you look at the actual rate of return compared to how much things really cost, I think you'll find that they underperform, even though they're supposed to perform. I think they're a little sketchy. You have to buy them at the right time. REITs, I don't like REITs, frankly. If you do a REIT, it's a publicly traded REIT. Real estate in good markets and bad markets doesn't, inflationary times, sometimes that doesn't necessarily make REITs go up. In fact, we've seen inflationary times in the last few years, and we've seen real estate take a dip because nobody can afford the interest rates to borrow it. So only private investors have been able to make money, but where it used to be 8 to 10% market cap rate, in other words, net return on investment, was what companies used to try to get. I mean, they're happy with 4% now, even with a 6% cost of borrowing money. I mean, they're trying to get 6 and 7 and keep up with inflation and interest rates, but honestly, they're not doing it. My son Taylor, who came from that business, can vouch for that. He left the business because they're just not able to keep real estate trusts, and private equity real estate is not keeping up with the rates that they had hoped. And if you're going to invest in them, you better be very picky and get very lucky and hope they're well managed, because typically the people that manage REITs take all the cream off the top and leave you what's rest. And it's not always what you put in. In fact, REITs have a bad reputation for that. I've probably had more horror stories or seen bad things and even lived through some 20, 30 years ago when I actually sold some of them and wished I hadn't, that they don't always work out. So I think you might want to look at maybe some private lending if you want to. That might help invest some of your capital. But there are also annuities that create an income stream that will guarantee a rate increase of 3 or 4% per year. Something like that might help. You're going to get a rate increase on Social Security. The other thing I'm going to tell you is just based on reality, and I've been doing this, I used to say 30 years, but I just realized I was a stockbroker exactly 40 years ago. I've been doing this a while, and it's really been retirement focused for 35 of it. So what I've seen is people don't spend more in their 90s, even if there's inflation, than they spend in their 70s, because they're doing stuff in their 70s. They're still paying down bills. They're still traveling. They're buying cars more often. When they're 90, they haven't bought a car for 10 years. They haven't gone places. Their kids and grandkids come to visit them. Health reasons are probably more to blame for that. The other thing is you've done all the fun stuff you want to do, and it's maybe you're doing more service-oriented stuff, or just basically the slow-go years. You're just not doing as much. I have found that people's assets, even though they might draw down a little quicker in the 60s and 70 age range, I see them growing again in the 80 and 90 range, even with the inflation factor, because the only thing that goes up for somebody who's already bought everything they need is food and gas, maybe utilities. And typically just the increases in Social Security have managed to cover most of those increases if it's just those things you're buying. If you're not buying a new house, if you're not buying new cars, if you're not buying new tech products and all these consumer discretionary type items, new furniture and things like that, remodeling your house. I mean, most people are kind of done doing that stuff by then. So I don't think inflation is as big a deal as, say, the Wall Street companies seem to make it. Because I see people that come from the big banks and they come in and say, well, my guy doesn't want me to spend more than this much money. I had a lady come in and she had just shy of $1 million in management, and they didn't want her to spend more than $1,500 a month because they were telling her that she has to plan for inflation and she might run out of money. I said, well, you've got to be a really horrible investor to run out of money and not plan for inflation if you can only take out 1.5% of your $1 million, or maybe 2% if you add up taxes and stuff that you're going to take out of there. So I think people give it probably, it's a real thing, but I don't think it's going to hit you as hard as you think. And that's my reality, because I've seen it with thousands of people over the years, that inflation, even though we have experienced some inflationary times, have not been as devastating as maybe the market, who wants to keep your money under management and continue to get fees and help you grow it. So for the rainy day, they just want to help you grow it so they get more fees. That's my opinion. I hate to talk bad about my associates in our business, but I think that's kind of the industry. And that's also the industry saying, hey, because we're taking a lot of risk with your money, you can't spend any, and we want to do the right thing for you. Well, if all they offer is risk, that's fine. But if they would offer you something where half of your money is creating income that you don't have to worry about, you can let the growth in good times on your investments cover the inflation in bad times. Because honestly, when inflation hits hard, the stock market typically doesn't go up. So they say the only way to keep up is I got to keep money in the market and those risky assets, or it won't keep up with inflation. Well, they rarely keep up with inflation during periods of high inflation. They make up the difference because they do really well in periods of low inflation. And that's when you have to compound that interest and compound those gains and take some of those profits off the table, put them in banks, put them in CDs, put them in annuities, put them in something safe, put them in LERPs, something that has principal guarantees, tax, and risk protection as you go. So take the profits off the table. You never get hurt doing that. And make sure you build a plan to where you have some assets that are growing to cover those inflationary times in the future, but also make sure that your income has a buffer in it, that you're guaranteed at least your bills are paid, so that you don't have to draw down those assets during slow growth times and then not have anything to cover you for those inflationary times.
Sam, good question. Thanks for listening to us in Reedy Ranch. And once again, if you'd like to further that conversation with Jeff, the number 520-780-9059. We'd love to hear from you. Jeff, Mark is listening to us in Savannah, and Mark says, I heard a stat that says 7 out of 10 people will need some sort of long-term care. I see that here in Tucson, the cost is about $9,000 a month and more for memory care. I'm 59 now and plan to retire at 67. This is the one thing that I have no plan for. What is your advice on the best way to plan for this expense if needed? And the average stay in a nursing home is around 3 years or so, Jeff. So he's looking at $325,000. How does he plan for something like that?
Well, the average stay is 3.5 years, and that's typically only if you go in when you're 50 and stay 30 years to make up the average for the majority of people that stay less than a year. It's actually less than a year for most people. More than half the people stay less than a year. So again, the average is 3 years, but if you have some problem that's chronic and memory care, usually if you're in your 80s or 90s and you're declining fast, memory care sometimes will, deteriorate you fairly quickly. But if you have memory care in your 50s or 60s and physically you're healthy and you don't know you're sick, maybe you live 5 or 10 years, that could be very expensive. Most people have a plan. I am not a proponent of pay-as-you-go long-term care insurance, because typically it isn't going to cover you anyway, and typically they're going to continue to raise your rates every time you get closer and closer to needing it. I think asset-based long-term care is the best way to go. In other words, use it if you need it. And by the way, 7 out of 10 people will need some sort of long-term care. That doesn't mean 7 out of 10 people will go to a nursing home. It probably means 20 or 30% will go to a nursing home. Some people will have visiting angels come and take care of them, get them a meal and help them get a bath a couple times a week. Some might need some home health care. Some might need maybe one of their kids takes care of them. So not everybody goes to a long-term care facility, and many people use home health care and are able to pay for it themselves. But yeah, on the high end, it is $9,000 or $10,000 a month. In 20 or 30 years, it'll probably be $20,000 or $30,000 a month. I wouldn't doubt it. So are you going to have $1 million to cover that? Honestly, most people, and you said I a couple of times, I didn't say we, so I'm guessing you might not be married. You may become married and probably want to support a spouse, but there's 2 ways that I really like long-term care protection. One is just if you have enough money, just have something earmarked for it. But Typically, it's your equity in your house. Your home equity is an asset, and unfortunately, you can't really spend it in cash unless you take a loan against it. Or you move into a nursing home. If it's your final days, you can either do a home equity line of credit, you can do a reverse mortgage and get cash out and keep the house just in case you want to save what's left for heirs or to move back in if you think you're going to get well. Use your home equity for that ace in the hole. If you got a $600,000 house now, it'll probably be worth $2 million 30 years from now. That's probably more than enough to cover a long-term care facility. By then, it'll be paid off. You could either downsize and sell it. Shoot, at that point, you might be able to even rent it out for what your long-term care costs you. I mean, still leave it in the family if that's the case. But a home equity is probably the simplest thing to consider. But of course, if you're married, you don't want to leave your spouse homeless if somehow you need all the equity to put yourself through a nursing home expense. So what do you do there? Well, there are LIRPs. I like life insurance retirement plans. And if you are 59, you can put money into basically your own tax-free bank account. Typically, it's been growing between 4 and 10% on average over the last 5 to 10 years. Let's just say 6 or 7% is the average growth rate in a tax-free environment, which is more than a CD. And what you do is some of that interest pays for a life insurance policy on you. So if you die, your spouse gets a tax-free death benefit that would cover that person's long-term care or other expenses, or maybe replace some income that he or she would lose if you pass away. The other thing that death benefit does is you can spend it while you live as income. Basically, you can spend money and borrow against that future death benefit, spend it, use it as cash, tax-free, never generates a 1099. So I really like it as part of your income plan. But the balance of the death benefit can be accelerated and used for long-term care, for terminal illness or other things that are chronic illness that may not otherwise require a nursing home, but would not be paid by nursing home insurance anyway. So LIRP has a lot of multifaceted answers to a lot of retirement plans, and that is income, tax savings, growth without risk, principal protection, long-term care, and chronic illness and terminal illness protection. So they're very useful. I like to use them for young people who are healthy enough to get it. And you might find that you don't need life insurance because you want to leave somebody a death benefit and make them rich. You need life insurance because you're going to spend it during your lifetime tax-free and use it to cover care should you need it even before you die.
Mark, thanks for listening to us in Savannah. And once again, 520-780-9059 is the telephone number if you would like to continue that conversation with Jeff. Again, it's no cost and no obligation. If anyone listening to the program today would like to have this individual conversation with Jeff at no cost and no obligation, once again, it's 520-780-9059. We call this the Retirement Roadmap. And really, as I said, this is just a casual conversation. There's no sales pitch here, just a chance for you and Jeff to sit down on a one-on-one basis and discuss your journey towards a confident retirement. Once again, it's 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back during the week and set you up with that appointment. 520-780-9059. You can also find out more about us online at primret.com. Jeff, the markets have been all over the place lately, and I think a lot of people listening are wondering, am I actually on track for retirement? Or am I just hoping? I'd like to walk through a retirement checkup list that could be a wake-up call for a lot of people. So let's start with the most basic question, Jeff. How do we even know if we're on track for retirement? Where do we begin and what do we look at?
Well, first of all, you have to see what you have saved, what you're able to save, when your retirement date is. If you're 5 years away from retirement, how much can you save between now and then? And also, how do you protect what you've saved? I mean, if you have everything in the market and you've got $5 million, it could be worth $2 million if the market doesn't perform. If you've got 500,000 and you want to get to $1 million, well, I hope you're saving and you are investing well to double that in the next 5 years. You've got to average 14% growth minus what you put in. So maybe you need 5 really good stock market years to get to that $1 million mark that you're looking for. I think most people are guessing. They're doing the hold and hope, and that's why they use the 3 or 4% rule. If they only take 3 or 4%, history shows that market crashes aren't going to kill you. However, if you have 2 market crashes in a decade, a guy named Wade Pfau, who's actually got a degree, a PhD in retirement income, did some actuarial numbers and found out that if we've had 3 decades, like the decade of the 2000 to 2010, if we had 3 decades in a row like that, you're going to be basically break even spending all your money. But history shows that that hasn't actually happened. So if you look at a historical worst 30-year period, it's probably about 1.8% is what his number came up with, is really a good withdrawal rate. So let's not guess that. Why don't we get a withdrawal rate where a company that guarantees pension plans would guarantee you 6 or 7% withdrawal rate. And if they're wrong and they run out of money, they keep paying you the income. If they're right and they make more than that, they continue to increase your income. Well, that's a lot better than a 1 or a 2% rule when you could use a 6 or 7% rule. That means you only have to tie up half your money in an income plan. So maybe your current savings gets taken off the table right away to create that guaranteed plan for the future on income. And at least it gets you to a level where you can at least figure that is. Now, everybody has a goal. Everybody knows what they're living on right now. Everybody has kind of an idea in their head probably of what they think they want to live on in retirement. The reality is it may be high or low depending on what your assets are and depending on how the markets really do. So you are holding and hoping and guessing. And if you want to guarantee that you can live on X number of dollars, then you need to have assets that guarantee against loss and guarantee income, period. That's it. That means stocks and bonds don't count. That means cash is pretty bleak and doesn't really count. That means the only way to go is an annuity that guarantees income. And that's why we use them for income. We don't use them for growth unless you just really have an aversion to the stock market. Maybe we would, because there are plenty of annuities that are indexed to the markets, will grow on up years, but they don't go down in bad years. That's not a bad thing for somebody that wants something a little bit more aggressive than a CD, but doesn't want any more risk than a CD. And you would have that opportunity with those type of assets, even to grow and park your assets. But I like to use them more for income. The rest of it, for the next 5 or 6 years, depending on when you're on track to retire, is how much can you save and how much can you systematically put into the market, and what's a realistic estimate of what that asset would be worth in 5 or 10 years or next year, whenever it is you try to retire. We add your Social Security up, any pensions that you get, and we can figure out what a realistic income is. If it's more than your income desires, or if you've really done a good budget, you know what your income needs are, then maybe you'll find out that you're way ahead of the game. You might also find out that you're way behind the game, that there's no way that you can expect to live on $60,000 a year if you only have $400,000 in savings. Well, I can say that just based on, I know the numbers don't work. And if you think about it, the numbers shouldn't. I mean, you know it doesn't work. Even if the stock market averages 10% and never has a down year and always has a 10% year, you're going to run out of money in 20 years or less. Probably less than that. Shoot, it's going to be probably 10 to 12 years. So you're going to basically blow through your savings a little bit too fast. We don't want you to do that. So part of our expertise, because we've seen plans and done plans over and over again. We've seen people start and finish their plans over decades, because we've been doing this 40 years now. My sons are a little newer at it, and people I work with are a little newer at it. We have longevity in our firm because we have generations following right behind me in my footsteps. But, having seen it over 40 years, we know what realistic savings is. We know what people really typically spend compared to their income. We also know what kind of emergencies might come up that you need a little bit of buffer for. We know what tax strategies work and what tax strategies don't work. I mean, we know a basic, just based on our experience, what most people are like. And not everybody's the same, but there's kind of some similarities where we know how much risk you should be taking compared to how much income you require. And we definitely don't want you to require income from something invested in tech stocks. We want that growth to come in tech stocks. We want you to make tons of money on tech stocks. I'm just giving an example, but we want to do that over a period of time. We don't want to have to rely on it on a month-to-month basis, but we want you in that. So we like the upside. When the market's good, we love making money in the good markets. We also like taking profits every once in a while and putting it someplace else, or doing something fun, or spending on something that makes your retirement more valuable and more meaningful and more memorable. So that's kind of the process, is look at where you at, where you want to be, divvy up the assets. And we've got not really an algorithm, but we've got a formula that we use that has made the most people happy and the least people unhappy. And we kind of know where to start. And if you like that plan, we go with it. If you want to tweak a little bit, we tweak it until you're happy with it. If you never get happy with it, well, then you move on to another guy that makes you happy. But whatever, we want to show you what realistic is based on our experience. And we do a good job because we pick up new clients come in on a regular basis and are very happy here.
Jeff, if someone runs the numbers and realizes they're behind, usually the reasons are, as you said, they haven't saved enough, they invested inefficiently for their circumstances, or maybe even lifestyle inflation. Expenses also have been creeping up over time. So you're listening to the program today, you're taking a look at these numbers, and you're realizing right now that you do not know whether or not you're on track for a retirement in which you thrive, not just survive. Call us here at Premier Retirement and request a conversation with Jeff. 520-780-9059. It's 520-780-9059. What we're offering here is a complimentary retirement roadmap review, and we'll show you exactly where you stand, what's working, what's missing, and how to fix it. No pressure, just clarity. This could be one of the most important meetings that you'll ever have. So you can call right now at 520-780-9059 and schedule your complimentary retirement review. Leave your name and telephone number. Shelley will call you back during the week and set that appointment up with Jeff. And again, it is just a casual fact-finding conversation. There is no sales pitch. 520-780-9059. We're also online at primret.com. Well, Jeff, we just get started and we run out of time. So for Jeff Vogan, I'm Jeff Shade. Thank you so much for listening. Be sure to join us again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.